Hello guys, how are you doing? What's going on? This is Prof from Bencov Forex Academy speaking. Before I start talking about what we are going to discuss today, I just want to remind you to support the channel by subscribing and make sure your notifications are on so that you don't miss any content as we upload it. Support the channel by subscribing, guys. In this video, I'm going to talk about market structure. I'm going to discuss everything you need to know about market structure and how you can take advantage of this video to better your trades, to make profits, to increase your success rate. So the three market structures that I'm going to discuss in these videos are the nature theory. I'm going to talk about how the market moves according to the nature theory. Then I'm also going to talk about BTMM market structure, and then finally I'll talk about the Elliott wave structure. Because I don't want this video to be too lengthy, I want it to be short and precise and straight to the point. So I'm going to divide these videos into a bit of series. The first video is going to talk about nature theory. The second video is going to talk about BTMM. And the third video is going to talk about Elliott wave principle market structure. Then after this third video, I'm going to do a combined video on everything that will show you how you can combine all these views on the market structure to have your own perspective of how the market moves and to take advantage of how the market moves. I'm going to condense everything into one market structure that you can take advantage of, which is very simple to understand and simple to follow. Just make sure you watch all the videos and up to the end of that video. So let's talk about the nature theory. Let's just move this a bit to the side and talk about the nature theory here. So according to the nature theory, the market moves in 1, 2, 3 impulses and corrective moves. What am I saying? I'm saying that when the market is moving, it's going to be consolidating at a certain point, then it will move in impulse, then it will start correcting again before we can have another impulse, then it will correct again before we can have another impulse. This is how the market moves. The market moves in strong expansions and accumulation and consolidation, then strong expansion, then another consolidation. This is how the market moves, guys. The market is not in chaos. The market is a specific way of moving, guys. This is how the market moves, and this is how we can identify a trend. Your textbooks will tell you that trend should have these higher lows and higher highs, higher lows and high highs. It's just the market moving in its own nature of impulse and corrections. So what is an impulse? An impulse is this expansion. Let me change the color a bit so that it's not hard for you to see. The impulse is this expansion that we are given here away from an area where price would have spent time accumulating orders above and below that move. Then a correction is a move that is counter trend, a move that is going to be counter trend, that goes opposite this impulse that you would have been given. So some call it consolidation, some call it accumulation. This move that is counter trend of the upward impulsive move that we had been experiencing is what we are calling a correction. Then from the correction, what we would expect is to have another impulse before we can have another correction. So the market continuously moves in this way of going in an impulsive phase and going into a corrective phase. It moves in impulse and corrections. This is the nature theory, guys. This is what we call the nature theory. Now, the basis of the nature theory is based on patterns. So as the market is going to be in a consolidation, what you need to do is you need to identify what kind of pattern is the market presenting you with. You need to then identify what kind of a pattern is the market presenting you with, so that you are able to take advantage of the next move. And you also need to look at the gradient or the measure of the slopeness of your correction to then see if the market is going to continuously go up or is going to reverse altogether. So this is the simplicity, ladies and gentlemen, of how market moves. This is market movement in its simplicity, and if you just master this alone, even if you don't consider the other market structures that I'm going to talk about, if you just master this alone, it can greatly improve your profitability. No matter whatever strategy you are using, you don't need an indicator to just know that the market moves in this impulsive and corrective phase, like what I'm just explaining to you here. You don't need any indicator or any stochastic or RSI to then know that the market moves in this impulse and correction. What you then just need to know is how then do you take advantage of these patterns. How best then do you trade these patterns? I'm going to do another video that will be explaining to you how you can take advantage of the different forms of the patterns that are formed when the market is in its corrective phase. What you also need to take note is that price is fractal. What does that mean? When we talk of fractals, we are simply saying that what is happening on the price action on daily time frame or on higher time frame is the same price action that you can expect to see on lower time frames. So what that means is, if you have these impulse and corrections on higher time frames, the price action is the same. Even if you go to lower time frames, you see that the price will still move in these impulse and correction type of moves. So in sometimes when you are in an impulsive phase, let's say you have just broken out of this consolidation here and you are somewhere around here and you want to take advantage of this impulsive move going to the downside, structure will tell you how far this impulsive move is going to go. I will talk about structure as we go. So if there's still so much structure to cover in this impulsive move, you can go to your lower time frames and look for corrections on those lower time frames, be it 5 minutes, 2 minutes, 15 minutes, 30 minutes, or 1 hour, or 4 hours. If you are working from higher time frames like the daily time frame, weekly time frame, or even monthly time frames, as we are going to see when we look at live charts. So you can go to lower time frames and still look for these patterns, impulse and corrections to take advantage of and join the trend. If we are going in an impulse, ladies and gentlemen, it's easier to follow where the trend is going rather than going against trend, because if you go against trend, half the time the moves against the trend are not going to be big expansions compared to moves that are following the trend. So what you would want to do is you want to go with the trend. They say the trend is your best friend, so you would want to go with your best friend so that movements where the trend is going are higher than the movements that are counter trend. So that's nature theory for you guys. So what we want to do now is we want to go to live charts and analyze and just look at the market according to the nature theory and see how best we can take advantage of this concept of market structure under nature theory. So if you are under nature, just one thing there, if you are using this nature theory, when we talk of a break of structure, a break of structure is a situation where now your price is broken down, the trend line or the pattern that is being formed. If we talk of break of structure here, the first line break of this structure is this upper trend line that we are seeing here. So when market has just gone above this trend line that you are seeing there, we are saying the market is what is a broken structure. And when it breaks structure, sometimes you would want to wait for break and retest, but that doesn't come more often than not. You would want to just take, I will show you the entries that you can maximize when you are taking this trade. If you are left with this other one that will be down there. Let's just go direct into charts and just analyze the market and just look at the market, how it presents these impulse and correction moves. Here I'm looking at V10S. Let me just squeeze the price a bit. I'm looking at V10S there. So if you can, it's just a quick look here, you can see that the market has given us an impulse move here. Here is the impulse. Let's change that color to a color that is different from the candlesticks that we have. So this is your impulse there, and there you are given a correction. After that correction, here you are given another impulse there. Then after that impulse, what do you have? You have another big correction. Then from that big correction, you are given a small impulse just to take you to above the highs. Then from that small impulse, you are given a correction. You are given a correction there. Then from that, you are given another impulse just going to the upside there. Then from that, there is a break of structure to the low. If you put your trend line there, you're going to see that the market broke this structure internally, forming that pattern there, the inverse head and shoulder, the head and shoulder formation that you're given there. We will talk about patterns in another video. Here we just want to discuss the nature theory. So make sure you subscribe to the channel so that you don't miss those videos as they come. If we look at it here, you have an impulse going to the downside. Then you are given a correction there. You are given a correction there. Then from the correction, you have another impulse. Then you are given a correction there. If you backtest a number of pairs, you're going to see that with experience, this becomes second nature to you. You just see these as price moves. You'll be able to see the patterns as price moves. You will not need to wait for them to complete. Just by seeing price action, you'll be able to see this as it happens here. You are given a break and retest from this correction impulse, then a deeper correction. I wouldn't then advise you to take these kind of corrections because they are a bit tricky. We will then show you a way of taking trades like this. It will not be based on nature theory, rather it will be based with the other market structures we are going to discuss. If we just zoom in a bit here, you're going to see that you are given impulse, correction impulse, then another correction impulse, another correction impulse. Guys, how much money would we have made by just seeing that there is an impulse correction here and taking note of the rejection candlesticks that are given on the upside there? Then from there, the market again, there is a break of structure there. If you put your trend line up there, there is a break of structure here, and the market started again moving what in impulse, correction, impulse, correction, impulse, correction, and now we are currently in another impulse. We might get a correction here on the top, but we are currently in another impulse going to the upside there. So this is how the market moves, guys. According to the nature theory, it moves in impulse and corrections. It doesn't work only on volatility indices, it also works on currencies. So I'm going to switch on my chart to trading view for currencies so that you see how also this applies on currencies. then we'll then maybe talk a bit about how then do you analyze, how then do you see where the market is going to turn if you are in an impulse, because it's not going to be impulse and correction forever. If you just see here, we were going impulse correction to the downside, but at this point here we then started reversing, going to the upside. How then do you know that it's now time for a reversal? And how then do you take advantage of that? How do you then manage your trades if you're in a trade? All those things, we are going to talk about them, guys. Let's just switch on our charts to trading view for currencies and look at one or two examples of how the market moves according to the nature theory. So here we are. This is GBP USD, one of my favorite currencies that I trade. If you check here, this is daily time frame, and this is an impulse, this is a correction, this is an impulse, and on a higher time frame, this again is an impulse and a bigger correction that is given us this impulse breaking this structure. If you check this movement again, you're going to see that you were given an impulse here, a correction, then an impulse, then a smaller correction and an impulse, and currently we are either forming a reversal or we are forming another correction. Patience is key, guys. When you're dealing with these things, you just need to be patient for price to develop into something that is common, something that you know. Structure is key when you are dealing with the nature theory. You need to make sure that you wait for price to form deeper structures that have enough price action for you to understand. You don't need your indicators to just know that price moves in these impulse and corrections. So after an impulse, you would expect a correction. After an impulse like this, I would expect a correction here, either price to then start moving in a corrective manner, coming back to retest these lows that have been formed here, that have been broken here. Let me just put a zone there. I would expect price to correctively move back to this zone before it can either continue going downside or before it can come back to take out this low and reverse up in a very fast move. We are going to talk about those things in other videos. Let's just check another example. So this is your DXY, this is your DXY, your index, your US dollar index. Let's just check how it has been moving. From the top there, you see that it gave us an impulse, correction, then another impulse and a bigger correction, which is a bit deep. Then another impulse. If you check here, price has been moving correctively up. Let's just indicate that it has been moving correctively up there. And after these three touches to the top, you would expect the price to break, and that's the break we're given there, the impulse down. After the correction, you're given the impulse. Then the price again, if you check the movement upside, you've been given another impulse and a correction, and now you're in an impulse which has now taken out these highs, and we wait to see how price will continue to move from there. So this is how price move, guys. So how then do you take trades if you are using this as your basis for market structure? How then do you take trades? Well, you then need to know these patterns, like I told you when we were starting. You then need to know these patterns, and you take your trades. If it's a pattern like this, you take your trades on the third touch to the top of that pattern. You would want to take your trades on every third touch of that pattern to the upside there. If you're in a downtrend, on every third touch of that to the downside. That's the basics of it. We haven't added a lot of things to it. The pure nature theory basis for trading, you just take your trades on the third touch of that. If you miss this third touch from the top of the baseline, then you take your trades upon break of this trend line here. You then take your trades upon break of the baseline on the bottom side or on the retest of that line. So just about when it's breaking, you just take your trade, but your stop loss now will need to be at the top of that channel. So normally taking trades on the break of the bottom line would be most ideal if you are dealing with lower time frames like 2 minutes time frame, 5 minutes time frame, where you know that you can put your stop loss at the top there. If you are on a daily time frame like this, it's craziness to put your stop loss at the top there. No matter how big your account is, you can't wait for days for price to then come and take you out. It's not good for your emotions. It's never good for your emotions. You just want to do that on what? On lower time frames. On daily time frames like this, you just put your structures. When you are given a reversal candlestick like this, what you are given here, this doji, then you know that you are reversing. When you are given another reversal candlestick like this one, then you know that the next day you are reversing. Then you go on lower time frames and look for trades. The same applies here. You are given an impulse, but the correction now, if you check the impulse and corrections that we were talking about, let me just go on a clear area so that I illustrate what I want to talk about here. If you check when we're starting, we're getting impulses like this, then corrections against the trend, then an impulse, then correction against the trend. This correction is going downside. It was going opposite trend. Remember, a correction should go opposite trend. But if you check the situation here is now different. This correction is not going opposite trend. It's going with the trend. So in a situation where you see a correction going with the trend like this, then it should be a clear indication that your price is getting tired, price is reaching exhaustion, and what you need to expect there is your reversal. So it's not sustainable for price to move like this when it's an impulse. So the moment you see something like this, your expectation should be what? A reversal. Then if you can have 2 points which you can join, where the third touch, where you can wait for the third touch to get reversal candlesticks on that third touch, then the better. You can then take your trade based on rejections that you get on the third touch. However, it is also important for you to look on the left side. What has price done on the left side? If you are making use of this nature theory, then it's important for you to then actually look at the other side of the chart to see what price has been doing, what are the higher highs. Then you mark your key areas of the higher highs, the areas of previous rejections, so that as price approaches that, you also take note of that. Let me just change this line to a clear color that we can all see, and move this up top a bit. If you then look at this price action given here, as price was going upside, approaching, it was approaching in a corrective way. It was approaching in a corrective way there. I'm not going to talk about these situations where price came back to hit this order block given here. I'm not going to talk about these order blocks that were given here. I'm only going to talk about this in accordance with the nature theory. We'll talk about order blocks when we are now combining everything and we are designing a good strategy that is profitable and high probability. So here, if you check, this was the previous high where price rejected and impulsively moved down. And as the price is coming back to that area, what you would want to do is to mark this area as your key area for reversal. You would expect price to reverse as it approaches this area here. So how then would the price reverse in this area? it is key to consider how price is moving back to that area which it previously rejected. So as the price is moving, you would want price to move in a structural way. You would want price to move forming a structure that is like this, that you can easily trace and see. If it is moving in a structure, it means it is accumulating orders, or it is accumulating then to get power to impulsively move what? Downside. So like you can see here, price came to that area here, it hit an order block. Then after hitting these order blocks, it came down. Then it started correctively moving up again. So after correctively moving upside, it took out the rejection block that is here by just going above this price action you are given here. Then after that, the price started impulsively moving down. If you were using purely the nature theory as I'm explaining it right now, then you do just want to wait upon close of this bullish candle you are given here. Some would have gone long, just based on this bullish candle here, because it has broken up a previous high. But then what you would want to wait for is, since you have seen that price has been moving correctively, it is rare that price will get power to go upside. Yes, there's a pattern we are going to discuss that is called a standing knife, which is not this one. But as you see price going upside, it is rare that it is going to get power to go upside, because it has been coming there correctively. Psychologically, people would not support the price there by placing their buy orders to go upside. Rather, they would be expecting to sell. So if you are using the nature theory, then you are expecting a third touch there to then go short. It is actually good after people have then taken their longs there. You then take a short position expecting this price to go down, and knowing that the price will impulsively go down in a very fast move, not to allow these guys to take out their positions, so that they are trapped in long positions. Then what happened? It then impulsively moved down. But this was not an impulsive move which we can compare with what previously happened, for example, here. So for management reason, as you see the move going down like this, you would then want to manage your trade well, because this is not convincing that it is going to continuously go down to take out this low. It's not a very fast move, but rather it respected the nature theory there. This is what we can use according to the nature theory. I'm going to talk in the next video about the BTMM, how price moves as the BTMM market structure. Then finally, as I promised, I'll talk about the Elliott wave. All these market structures were designed from the Elliott wave, so it seems. So we're also going to talk about the Elliott wave and how it then accommodates and consolidates all the other two market structures. That will help you analyze your charts in a way that you have never done before. Thank you very much for watching. Don't forget to subscribe to the channel. Support by subscribing. More videos are coming.